My name is Chris Kilcullen. I am a hotel broker with Avis and Young Real Estate. I work on projects all over the country and have spent quite a bit of time on hotel conversions to apartments over the last year and a half, actually 2 years now. And this is one of the projects that I'm super excited about. David Peters and Ron and Karen Holiday and Jacob McGlade from First Floor Equity. They're the sponsors of this project and obviously the buyers, and we've been working very closely with them and excited to have them present what they're going to do with the property. Pamela Hayward is going to walk the property and act as our Vanna White. So I'm going to turn it over to David and Ron and let Pamela start showing you the property. Oh, one more thing. If you can add any comments, any questions to the chat, we'll try to answer some as we go along, but at the end of the presentation or at the end of the walkthrough, we'll go through and answer them all. We did that last night and it was really effective.
Okay, well, thank you all for joining. First of all, one of the reasons we're super excited about this project is, as you can see, looking at the building, it looks a lot more like an apartment building than it does a traditional hotel. And I think that's going to make the conversion that much easier and look that much better than when we're done. Pamela, if you could pan a little bit right to left. The first thing we're going to do is revamp this parking lot completely. So that porte cochere you see in front of the building, that's going to be removed, and there'll be a smaller structure there that will just, kind of protect the front door, but not be quite so imposing. Again, look more like an apartment building and less like a hotel. We're going to be regrading this entire front area and adding about 24 more parking spaces. We will be retaining all the mature trees here, but we think that's really nice. The other thing that's really great about this particular property is the current owner has already spent about $2 million in remodeling. And so 100 of the 143 rooms have already been brought up to the new La Quinta standard, as well as the main lobby area that you're going to see in just a minute. Now, the other great thing about this property is the rooms are all relatively large, the smallest one being about 360 square feet, which is actually quite large for this kind of a property. And we're converting one for one. So we're starting with 143 rooms. We will end up with 143 micro apartments when we're done. And there's a real advantage to having that size because that gives us enough revenue to be able to hire an on-site manager and have staff just like a traditional apartment building. Now, as we're walking through the lobby here, you can see it's quite nice the way they've done it. We have a couple of these electric fireplaces that look really cool. Our plan is to divide this particular area into three separate areas. So one will be like a TV conversation area. We'll have a game room area, and then a full kitchen will be behind those glass sliding doors that you see. In the game room, we're planning on putting, pool table, foosball table, maybe some darts, something like that, just make it kind of a fun place to gather. Then as I said, we'll have the conversation / TV watching areas. And then in this area right here, behind the door is where we're going to put the full kitchen. So there'll be a full kitchen in there with everything you would need to cook your Thanksgiving dinner if you so choose. It will be open to all the residents. And then if you turn around and look out to the courtyard, you can see through the windows here, there's quite a nice courtyard. It's quite large. There is a swimming pool out there right now. The ongoing plan is to remove the swimming pool, and we're going to fill in that area and put in a pickleball court. In the rest of the courtyard area, we're going to redo all the landscaping. Unfortunately, the bigger trees out there have reached the end of their lifespan, so those are going to be removed, and we'll be putting in. Excuse me. Should turn that off. So I'm sorry. So we'll have a fenced dog area. We're going to put a pergola out there. We'll have the pickleball court. We'll have 3 grilling stations, and as I say, we're going to completely re-landscape the area with lighting and the outdoor furniture, and it should be quite an inviting space.
Again, just to add another quick comment, as you look at this, you can see that this doesn't feel like your typical hotel complex. This already feels really like an apartment building, which is a great asset for us because it saves us the effort of having to try and remove sort of that hotel feel and convert it into the feel of a normal apartment residence. I mean, this looks like any typical 1980s built apartment building already, which is just a huge advantage to us.
And when we're done remodeling, it'd be a 2022 apartment building.
That's right.
Now in this area, this is currently a meeting room. Our plan in here is to convert this into the workout room. So we'll be completely remodeling, put mirrors on the wall, we'll have the rubber flooring, probably have 2 or 3 exercise bikes, a couple treadmills, an elliptical, a full weight machine, free weights, and you'll have a lovely view out to the courtyard while you're working out.
Really nice.
And again, as we go through this and you see the different amenities we're including, I mean, basically this area of Overland Park is a Class A minus area. And pretty much all of Overland Park is AB area. And this particular property, as we add these amenities, while some of the rooms are efficiently sized, obviously, 360 square feet isn't huge, but the property itself is going to live very large because you're going to have a full set of brand new Class A amenities that are going to be very attractive to people. And we have a certain target demographic. We're not expecting that everyone's going to live in this building. We're not expecting that you're going to, see families living in this building per se. There's 2 primary target demographics that we address with these projects. One is the single millennials or single workforce housing people, and the other one that we really like is the 55 plus active adult, which are people that are basically transitioning out of some other, maybe say, single family home that they lived in the area for a long time that's now become a burden to take care of, and they just want a freer, easier lifestyle. And we found that those people tend to be fairly sticky residents. They're not looking to move every year. And they are also the largest growing demographic in the Kansas City market, and a lot of markets, I guess, probably, but specifically in this market, they are the fastest growing demographic. So we definitely have a lot of target market that we can hit.
Now this particular room type is called an Executive King, and so it has this little half wall there and the couch, as you see. As Pamela spins around, we'll be able to see kind of the back wall of the bathroom right there, the gray wall. That's where we're going to put the kitchen. So there'll be a complete kitchen / kitchenette, whatever you want to call it there. So we'll have an apartment size refrigerator. There'll be a 2-burner induction cooktop. We'll have obviously a sink, dishwasher, microwave, all the amenities you would need to fulfill your cooking needs, and it fits in there very nicely. Now with this particular layout, it's very probable that the residents will put their bed where the couch is now and put more of a seating area next to the kitchen. But that's obviously, the choice of the resident.
Really good example of how it'll fit though.
Another comment I would make is that this is essentially the smallest footprint room that we have, basically. And if you look in there, you see that, while obviously it's what we would call efficient in size, it's not cramped or tiny. It's approximately 360 square feet versus typical hotel rooms that run 275 to 300. That extra, 60, 70 square feet makes a huge difference in the livability, the comfort level of living in a space like this. And that's another reason why we chose this property, was that the smallest rooms start at 360 and they move up to over 700 square feet, and only half of the units are at that 360. So we have a really nice unit mix. Just slightly more than half are at that 360. So that's not very common in hotels. Many hotels have, 90% of their rooms are those 275 to 300 square foot rooms.
Dave, will we be able to see the largest unit in there too?
Yes. Now, as she's walking down the hall, I mean, this is, as I said, has all been remodeled. So that's all new carpeting and new wallpaper on the walls. They got the exposed concrete ceiling, and it just looks very, very modern. The building is almost completely concrete, so it has a couple of advantages. Number one, you can't burn it down, and number two, it's very solid and very quiet when you're in there. You don't hear noises from the adjacent units. And quite a few of the units have balconies, as you may have seen from the outside, which is another nice amenity. And as you can see, the tile, I didn't get to comment when they were in the bathroom in the other unit, but it does have a smart mirror on the wall. You can play your Bluetooth through it. It's got really nice tile work that they just redid. As I said, this has been done in 100 of the 143 rooms. There's the smart mirror.
Super smart.
Just wanted to show the tile work again. I'm kind of impressed with the tile work myself. They did a nice job.
Yeah, that definitely has a spa style feel, right? I mean, that's upscale. That's not, Class C apartment.
So in the already renovated, like these rooms, the only thing we'll really be doing to them is putting in those kitchens. Now, we do have 43 rooms that have not yet been remodeled, so we will be remodeling those basically up to this standard and putting the kitchenettes in. Now, this is one of the, Pamela, did you call this a 2-room suite?
That's correct, it is.
So this is obviously one of the larger rooms.
Separate bedroom area, nice big open living space.
And obviously each room has their own heating and cooling unit right there. Now see, this one already has sort of a little wet bar area, I would call it. As I say, what we'll be doing there is just removing that small divider wall and using the whole wall for the kitchen. So it'll fit in the same way. We'll just get rid of the desk. But we have the advantage, the plumbing's already there, so that makes it even a little easier.
Yeah.
I mean, that unit right there is, a very typical, like, smaller apartment size unit. It's not what you'd consider a micro apartment by any means. I mean, you're looking at, I think that unit was roughly what, 600 square feet, I think. So, I mean,
yeah,
I have
up to 700 square feet. There's 3 different sizes of those 1-bedrooms.
Right.
So, Ron, one of the questions we had yesterday was about elevators. You want to talk through stairways and elevators while Pamela's walking?
Oh, absolutely. Yeah. So there's 4 stairwells in the hotel and 2 elevators. So they're strategically located, as we like to say.
Yeah. We
do have a common laundry area for the guests, and we'll be putting in a couple more laundry areas on the different floors. So there'll be plenty of access to washers and dryers. Now, somebody asked about utilities. Now, our model is to offer the units with all utilities included. So that's obviously heating, electric, gas, sewer, water, but we also include high-speed internet and cable TV.
Right. That's our value proposition. Essentially, people will say, hey, look, I can rent an apartment, a 1-bedroom apartment down the road for $1,200, and you guys are, $1,100. You're only $100 less. And we say, well, that $1,200 apartment doesn't actually cost you $1,200 though, right? Because you're going to have to pay these utility bills. You're going to have to get your own internet service, most likely your own TV streaming service, and you're probably not going to have the amenities that we have, or if you do, they're not going to be, really nice and brand new like we have. So we can basically, justify that really the cost of that other unit might be $150 higher than, that $1,200 rate. So really they're saving a much larger amount by living here, and they're in essentially, an almost brand new Class A apartment complex.
And we have incredibly good internet. It's on Google Fiber, so you get 300 MIPS.
Ron, do you want to talk a bit more about the courtyard? Pamela, would you mind stepping back out to that courtyard a second?
Sure. Yeah, as I said, we're going to be filling in the pool area and putting in a pickleball court there. As I said, there's 3 or 4 mature trees, bigger trees out there that unfortunately have reached the end of their lifespan, that one in particular, that we'll be taking out. We'll be re-landscaping the whole area, going to be putting in a fenced dog run area. We'll have a nice pergola. We're planning on 3 upscale grilling stations and some nice outdoor furniture. So when it's all done, it should be very inviting.
Yeah. Lots of open space.
Yeah, it's quite large for this type of property.
And again, we might want to, I'll talk more about it when we go outside later, but this area is, it's a very good area. It's a very safe area to live. It's also not right on the main drag. It's just off the main drag. So from a traffic and noise standpoint, you're not going to have all that main drag traffic, but yet at the same time, you're very close to things. And one of the things in studying these types of properties, and in fact apartments in general, people do have a desire for walkability, and this particular location is walkable to entertainment venues, it's walkable to restaurants, and very importantly, it's actually walkable to a boutique Walmart that's just up the road. And people have, traditionally people think, well, what do people want to be close to? Well, they really want to be close to restaurants, right? But no, I think in surveys they've done, the most important thing is being close to, a real grocery store, not, a gas station grocery store, but an actual.
Yeah, no Quick Trip.
Right.
And you are kind of up on a hill. You can see it's really evident when in the winter time when there's no leaves on the trees, but you have quite a view going down that way. And if you turn the opposite way, we're right next to a facility called the Atrium, which provides, memory care and, assisted living. So kind of like the next step up in acuity. So we're thinking if people come there, they're in the 55 plus age group. As David mentioned, they tend to be very sticky clients. They may hang around for quite a while. Maybe even until they're ready to move next door because they need more services. So there's a draw for that.
And I would also comment that the place next door does offer independent living apartments. However, they bundle it in with meal service, and that base level is $2,200 a month for, basically a 300 square foot hotel room. And then obviously they have amenities similar to what we're looking to put in. They won't be brand new like ours, but they do have amenities. But basically it's kind of like, well, do you want to pay $1,100 a month to live in our 360 square foot unit? Or do you want to live in a 300 square foot unit for $2,200 a month, but you get some meals? And I think there's going to be a lot of people who are going to say, hey, I will, you know, I can get my meals cheaper than that. So I think that's definitely an advantage of being located here, is that we are going to be, you know, advertising, and we're going to be right next door to a place that, you know, offers the same services essentially at a higher price. And that particular complex, the Atrium, they're a regional group. They have multiple facilities, so they do a lot of marketing, and I think we can gain some advantage on that marketing as they drag traffic into the area, and we pick up some of those people.
Yeah. And one of the things we've done a lot of with our other properties is, you know, internet marketing. So targeted marketing. So if somebody searches for, you know, assisted living or, you know, the Atrium, our ads can pop up, and obviously I think we're very competitive to them.
Right, and I would bring, just to make a point, that this is the third project like this that we are the lead sponsors on. So this isn't our first rodeo as a lead sponsor. So we've tuned in and I guess dialed in our business plan, and we've dialed in our processes and procedures, and so we're familiar with the whole process from start to finish. And we do things a little bit, you know, unique from most groups in that we're going to operate the hotel from day one, and we're going to slowly transition out of the hotel as we finish units. So we are going to have some cash flow. We're not just going to mothball the place for 6 months. There again, you can feel here that we're not, you know, in an industrial park. We're not in, you know, a high level commercial zone. We're in an area that's relatively quiet and feels residential. There's an apartment complex behind us on the one side, like you mentioned, the Atrium on the other side, and then there are some other hotels in the area too, which is another reason why it really made sense to convert this property, because there's really a lack of housing in this area. Housing is becoming very, very tight. I don't think I mentioned this yet, but we did some research, and basically for 2022, there are not going to be any new housing units built in this area. In fact, Overland Park reported 0 for new housing units in 2022, and vacancies have come down from a few years ago, 7% down to where they're below 3% now, and with no new housing units and continuing population growth and job growth, Kansas City is a very strong market for job growth. In fact, they're anticipating 24,000 new jobs just in 2022, just in Kansas City.
Yeah, and something
basically
we may not
vacancy is going to go to almost 0.
Sorry to interrupt you. I was just going to say, and importantly, the zoning has already been approved for the conversion, so that's not an obstacle.
Right. Yeah, I think that the city. In fact, the planning committee for the city, when they initially took this to the city, voted 9-0 in favor of it. So clearly the city agrees with us that, you know, there's plenty of hotel capacity in this area, but there's definitely a need for housing, and our strategy is definitely on the affordable side. A typical one-bedroom apartment in this area is about $1,300 per month plus utilities. So our pricing strategy is clearly aggressive in that realm. And I guess the other thing I should talk about is we had a national expert do a rent feasibility study on this project back in March, based on our 1095, 1195, 1295 pricing strategy for the different types and size of units. And he came back basically with the result that we were definitely on target, but in including the utilities and the internet and the streaming video service, we're basically 10% below the market. And that's based on March of 2022 pricing. And we are looking at holding our financial projections that we've put out are based on holding that rate all the way through the lease-up phase before we actually start raising rates. So by the time we get through lease-up with inflation and, you know, rent growth in this market has been steady, which is good, but it hasn't been exceptional. So we're not looking for a pullback in rent, especially with the lack of supply. So we're probably going to start, 16 months out, probably 20+% below the market. And then we're going to, when we do move up, we're going to, our plan within the projections at that time was to move up 5% a year for the 4 years, which wouldn't even catch us up to the market at the end of the investment in 5 years. So, obviously we're going to work with the market. We may, move up more than that planned 5% initially, which is then going to obviously increase improve our financial results further. So I guess the point of it is just that we were very conservative in our revenue estimates, very conservative in our occupancy based on previous history of the other projects we've done, and very conservative in our exit cap rate. So all in all, every step of the way we've been conservative in our projections. Which
David, you might talk about the exit cap rate as well, but also I don't think your projections for the other revenue that you're going to start collecting for the storage units that you're building, and then the carports for additional rent income, they were not built into your projections, correct?
No, nor is pet rent or any of the other incidental fees. So we didn't put any of that
or laundry or any of that stuff. Yeah, we basically built in a very small amount of other income.
Great. And the cap rates, I've seen some of these trade, in the 4s and 5s post opening. And what cap rate did you have built into the model for distribution?
We built in a 6 cap rate, but the overall project will be pretty close to a 20% IRR, even at a 7 cap rate exit. Right. So again, I think Pamela's come to the end of the tour, essentially. I mean, showing off our fancy fireplaces there. And like we said, again, our previous, people always ask, well, who's going to live in a 360 square foot unit? And I mean, obviously, I'm not the demographic who's going to live there. Maybe most of the people on this call aren't the demographic, but we're looking to address approximately 20% of the market, as opposed to, a traditional apartment building, which might try to address 80% of the market. But we know who our target market is. We have very good marketing to that target market, and our previous projects have proven that we definitely have the demand there, and these units do fill up. And I will say that there are a couple of hotel conversions in the Kansas City area, and we researched those conversions, and what we found is that they were basically all 100% occupied. And in fact, the closest one to us, when I spoke with them, they did not have a single unit coming open until August. So the market is definitely there. And again, we're 143 units in a sea of 200,000 units in that area. So
hey, David,
we're a very, very small percentage.
Hey David, this is Jake. There are a couple questions regarding financing in the chat, and also cash flow in year one. If you could address those, that would be great.
Sure. Yeah, we'll definitely. I think. Did you have any other commentary, Ron or Chris, or should we move to going through the chat box question?
Yeah, I think we could go to the chat box. That's a fine idea.
All right, thank you, Pamela, for the walkthrough. Thank you. If y'all can remove y'all pen, and we can go through the chats right now. Chat questions. I think Jake did a good job kind of going through the chats. Do you see it? You up, David?
Yeah, I'm scrolling here. I think the first question was, when were the renovations done? And it was since 2019, basically the last 2 years. Let's see. The reason we're removing the pool is there's a couple reasons. Liability is certainly one. Maintenance is another one. Maintenance of pools is a huge undertaking. The popularity of the amenity, we find that, a pool's nice, okay, but people really are just, they're looking for the top amenities they really want are the ones that we're putting in there, and that's why we're putting them in there. They want, a space for dogs. Lots of, single people have small dogs. They want outdoor grilling stations. They want, a gathering space outside where they can sit down with a few friends and, eat some food or have some iced tea in the afternoon and chat about life. They want some active areas, and that's why we're putting in the pickleball court. Those are the prime amenities for outdoors that we've seen as far as surveys that we've seen of these types of complexes and senior living complexes. Now, we're gearing this property toward 55 plus active adults from a marketing standpoint, but we're not doing anything or restricting anything to keep out the other key groups either. I mean, certainly millennials and some, individual workforce housing people will probably live there, and that's fine. We're not an age-restricted community, and we definitely won't, bypass those segments in our marketing, but our primary target is those 55 plus for two reasons. One, they're a rapidly growing segment of the population, and two, they tend to stay longer than anybody else. And, if we can minimize turnover, we're going to maximize financial results. So that was kind of a real long answer to a real short question. As is typical with me, unfortunately, but.
Yeah. Well, David is great with the details. Ask him what time it is, he'll tell you how to build a watch.
Hey, be nice.
As
they have the signs on Shark Pool, be nice. I didn't bring my be nice sign.
Yes, somebody asked about revenue, and I think what we were projecting there when it said 0 in the first year was really return to the investors. We're just projecting 0. The actual revenue we're projecting in the first year between the hotel operation and the apartments as we start leasing them up is about $350,000 in revenue. But that really is pretty much going to cover the expenses, so the staff and et cetera. So that's why we're essentially saying 0 revenue to the investors in the first year.
0 distributions to the investors.
Yeah, 0 distributions.
Just to be conservative, but let's talk about distributions in general, okay? The structure is such that there is basically two classes of shareholders, one being our sponsorship team and the other being all the equity investors, of which we are also part of. We do invest equity in every deal that we do, and we sign on the loan, and this particular loan is a recourse loan. So obviously we're committing that, we're in and we believe in this project, and we wouldn't be doing it if we didn't. So
yeah, as is the seller.
Right. Yeah. Now let's make that really clear too. The seller is not providing carryback financing. So the seller is not providing a second mortgage that sits below the equity. The seller is coming in as a common equity investor with all the rest of us. And the way we structure this is we have it's a fairly simple structure and a fairly simple waterfall. There's a 7% preferred return that accrues from day one. So even though you won't likely be receiving distributions in year one just because that's our renovation year and we aren't throwing off a lot of positive cash flow that year, you will receive that money accrued. It will be paid out later as soon as we can once we get the apartment building completely leased up and fully stabilized. So that's first, the 7% preferred return each year. And then after that, it's a 70-30 split between the equity group and the sponsor group. And that 70-30 split holds all the way up to a 28% IRR. So that's much higher than what you'll see in typical multifamily waterfalls. I think typically you'll see them start to roll off around 20% IRR, maybe even 18% IRR. And then at 28%, it's 50-50 from everything above the 28% IRR. So that's it. That's basically the whole structure. It's clean and it's simple. We don't have, a lot of complexity there to deal with. It's pretty straightforward.
Yeah, the one other thing I wanted to comment on, somebody was asking about our renovation budget or our CapEx budget and why it was so high. We have $4.6 million set aside for CapEx, but the important thing to keep in mind that $3 million of that is general upgrade and maintenance of the building. So essentially rebuilding the parking lot, replacing all the windows, putting on a new roof, all of those sorts of things. That's going to take about $3 million. When we look at the actual in-room budget, it's about $10.5 per room that we're actually putting into each room if you break it up that way. So it seems like a big number until you look back and see that we're almost rebuilding the structure so that we really do have a Class A product when we're done. It's going to be a brand new 2022 apartment building when it's done.
And I would also add that of that $3 million, there's that, all the common spaces that are being redeveloped, right? The fitness room, the changes to the lobby to finish out the lobby, obviously the courtyard, right? Huge amount of improvement in the courtyard. So that's where, like you said, that $3 million goes. And basically in the units, the 100 that have been remodeled, our primary function in there is to add the kitchenette. And then obviously we'll finish out the remodeling of the other rooms to make them, a consistent, Class A quality finishes throughout. And I think new windows in all the windows, which is going to be a big benefit to the residents as well, because the current windows are obviously dated and leaky. And so we really want to, if we can do everything up front, that's going to make us more profitable down the road, because we're going to eliminate a lot of maintenance costs over the, coming hold period, right? Because everything's going to be new and refreshed. So I just prefer that strategy rather than trying to do a lot of, maintenance out of cash flow.
Right. And we are borrowing the money to cover all that up front. We're not, like you said, not planning on using cash flow for remodeling purposes.
Right. The project budget includes all those items up front, so that way we don't have to worry about trying to fit them into budgets later.
Dave, were there other questions we needed to address?
I see one here that asks about, will the utilities approach be changed due to oil price continually rising? And I don't think the approach is going to be changed. We don't really have any plans to change that. Our one price strategy has been very effective, especially for that 55 plus age group. If anything, what we might do is actually raise that one price a little faster than planned to compensate for, if utilities really get. And again, there again, we can always talk with the potential residents and explain that value proposition, right? Because they're going to pay for it one way or the other. They're either going to pay for it individually as a higher price, living somewhere else, or it'll be included in their price here. So I think that's kind of a net zero, in my opinion, at least.
Yep. Somebody asked,
are you going to have any furnished apartments that you'll use through Airbnb and VRBO?
Yes, thank you for prompting me on that, Chris. I don't think I mentioned that anywhere in the presentation yet.
Details.
We are looking at allocating initially probably about a dozen. Well, first of all, let's talk about somebody has asked questions yesterday about are the units going to be furnished? And the answer is at the prices that we're doing for the leases, they will not be furnished. They will be unfurnished like any other typical apartment. However, we will offer an option, because we're going to have some of this furniture left over, obviously, we're going to plan to keep a small amount of it. So we will offer the option of providing furnished units, but that will be an upcharge to the resident. And second of all, we are looking at keeping approximately, initially maybe a dozen units. Obviously, we're going to be market sensitive on this, but a dozen units will stay as Airbnb units once the hotel closes. And we want to make sure people understand the differentiation there. Hotel guests have a different expectation of service. They expect to be able to see housekeeping. They expect to be able to see front desk people. They expect to have instant or as fast as possible maintenance service, right? And that all means higher staffing levels and higher expense. And so once we get to about 60% of the units being ready as apartments, we're going to shut down the hotel operation and shift to an apartment operation, which will mean reductions in staffing and labor costs, of course. But Airbnb people, definitely, they expect to have a nice unit, but it's a unit, right? It's almost like they're living in someone's apartment for, or their home for a week or 2 weeks or however long they end up staying. And we've seen that Airbnb tends to bring us a lot of extended stay guests. We see, a lot of business that we wouldn't necessarily see coming in through typical hotel channels like online travel agencies. And that's good business for us because the Airbnb guest has that expectation of having a nice space, but doesn't have that expectation that the hotel guest has. So we don't have to staff like a hotel to run some Airbnb units. And we definitely, we know that the market isn't going to support 143 Airbnb units, but we'll just kind of start with probably about a dozen. And if we find that, if we can't keep 70% occupancy in them, we'll adjust that number accordingly. Now, if we see constant 100% occupancy with wait lists, we may adjust further in the other direction a little bit too. But obviously, we have to be cognizant of the fact that Airbnb is a little bit more of a seasonal thing probably than, obviously residential apartments.
Somebody's just asked, how do we do the hotel operation while maintaining the renovations? Well, essentially, this is a very large building. It's 3 stories, 143 units. What we will do is start and there's doors that close off the different sections between the stairwells. And so what we'll do is we will close off one section of one floor and we'll renovate those rooms to apartments. Once that renovation is finished, then we'll begin leasing up those units and move on to the next section, close that off. We'll probably have about somewhere between 70 and 100 rooms when we first start out that we're going to be using as hotel rooms. And obviously, as we convert to apartments, that number is going to decrease. And as David said, once we get to about 60% apartments, then we'll just cease the nightly hotel operation altogether. But essentially, it'll be physically separated.
Yeah, I think maybe I can just talk a little bit about the whole staffing transition, because basically hotel staffing, well, first of all, I guess I'll back up even further and say that when we do these projects, we are, through the transition, we are the property manager and we are the asset manager. We don't outsource property management during the transition because we feel that we have the experience. We're the ones who have gone through this, and we want to maintain tight control on the process during the transition. Once the property is completely stabilized on the other side of the renovations, then we can go look for a high quality property manager to take over that role. But until then, we will be fully engaged. In other words, we will be the property management and the asset management. And then speaking to the staffing, obviously hotel staffing, we will have to have front desk for at least a fairly good period of hours every day. We'll have to have housekeeping, we'll have to have common area cleaning, we'll have to have, maintenance staff available all the time, because when issues come up, hotel guests expect to have those issues resolved pretty quickly. But as we move into the apartment staffing level, basically we'll have one full-time on-site property manager. We'll have probably a full-time leasing agent as we move through lease up, and that person will probably move to part-time as we get toward the end of the lease up period. And then we'll have a full-time maintenance person and a light maintenance / cleaner on staff. So the reason we like this size property is because of the fact that it's large enough that it supports on-site staff. We generally don't target 40 unit hotels to convert, because those basically become a project that maybe an individual owner wants to take on, and they're buying themselves a job because there isn't enough work there that we can have an on-site staff. The economics don't afford it, and the project is just too small for our strategy. So basically we target stuff starting, say, maybe 90 units on the small end, 80 to 90 units, and probably 160 on the upper end, just because there again, we know that we don't have, we're not going to address 80% of the market, we're going to address 20% of the market, and we don't want to saturate the market with units. And obviously we carefully select the markets we go into as well. I mean, we're not going to buy, 100 unit hotel in the, middle of a 1,000-person community in Oklahoma. I mean, we definitely are very strategic in where we look to buy these properties, and that's why Overland Park has just such fantastic demographics, and it's just a really, really strong rental market, but yet it's not a market that's been overrun by, say, institutional investors yet. It's a market that people in the area, in that region, know that market really well, but maybe Wall Street guys in New York aren't too tuned into it. So it makes a real good, I guess, you could use that sort of, I don't know what the word is, but emerging markets, basically. This is definitely, it's a market that's been strong for a long time, but it's definitely getting even stronger for the rental.
Yeah, Chris, you were saying the World Cup's going to come to Kansas City, maybe.
Maybe Chris got on something else.
Sorry, I couldn't get myself off mute.
Yeah.
Yes, they announced last week the World Cup is coming, and the NFL draft is actually here this month or this year.
Oh, cool.
Yeah. Soccer is really big in Kansas City. The National Federation of Soccer, whatever they call themselves, where they train all the referees all across the country. And train coaches, is all based in Kansas City.
And don't forget the barbecue.
Who can forget the barbecue? I mean, come on. We've got it. I'm from Texas, so I know good barbecue, and Kansas City's got some remarkable barbecues.
Cool. Were there more questions, Dave?
Yeah, well, I haven't made it through the chat yet.
Okay.
There was a question about group activities being arranged since we're targeting that 55 plus age group. And I would say we're definitely going to have, maybe not activities to the level of, say, the complex across the parking lot, but we definitely are going to, our property manager, our on-site property manager will definitely be involved in, setting up activities that will create a sense of community. We definitely want to do that, because I think that's very key in providing the most enjoyable environment for the residents and retaining them, right? Because if they're happy there and they start to, intermingle and become socially connected, they're very likely to stay.
Well, and that was kind of the idea behind the communal kitchen too. I mean, if people want to do potlucks or, have a birthday party or, a family gathering, whatever. I mean, there's a place to cook and prepare food. They'll have conversation areas where they can sit, the game room, go play pool or whatever. So again, it's all about that sense of community.
Right. Yeah. There's a lot of common space, a ton of really nice amenities and common space here that, again, as I said before, make the unit live much larger than, just that physical space.
I think Matt here asked a question about when does the window of opportunities to participate in investment close?
Well, right now we are looking at a July closing, sooner versus later. I mean, I think it kind of depends on getting the final things wrapped up with the lender. Really, that's probably going to be the long pull to get to closing. But we may have an opportunity to invest after closing. There may be a little bit of, we may close and then raise the final small portion of the renovation funds post-closing. We want to get closed as soon as possible because we really want to get started on the project. So I think, like I said, I think there may be an opportunity, but obviously it's first come, first serve. I mean, there's a potential that, there may be still available equity to get until the end of July, maybe, but I wouldn't count on that. I mean, it's just first come, first serve. And the other thing is, we're talking to several, small equity groups that are expressing interest too. And I mean, if one of those decides to pull the trigger, then all the equity is going to be gone. They'll just take everything that's left.
I guess the short answer to that question is right before the last check is received.
Yeah, there you go. That's exactly right.
Matt had another question. How much is debt and equity? What is your loan to value or loan to cost?
Oh yeah, let's talk about that just a little bit. Our plan is to use a local community lender, and that community lender currently holds the outstanding note on the property. So they have intimate knowledge of the property. So it's not like we're going to a lender that's based out of New York that, just cares about making a certain margin on their loan and has, no familiarity with the property. So I think that's a huge advantage, that the lender is very familiar with the property. The lender is offering us a fixed rate loan for 5 years with the option to extend another 5 years, but they retain the right to reprice at that 5-year point. We're looking at pricing somewhere in the low 5s for that fixed rate. So that's fixed rate. I just want to make that really clear, because a lot of people are doing some forms of variable rates with rate caps and things like that, and we're not doing that at all. We're doing a straight fixed rate. It's 2 years interest only, and then the final 3 years are at a 25-year amortization. So I think it's a very competitive loan package, really, and I think it having that fixed rate de-risks us. I mean, I think what you're going to see, historically, we've seen that, interest rates spike, but they're probably not going to stay up there at that peak of the spike for 5 years, right? I mean, they're going to spike up, they're going to be up there a year or two, and they're probably going to start to work their way back down. But by having the fixed rate, we control our lending costs better.
I think it's a great way to kind of segue to this question here. Vlad asked the question is, do you see any risk with the looming recession and or potential stagflation?
I would say no, because we're on the more economical end of the spectrum. I think the people are going to get killed there, or the people who are building new apartment buildings where rent starts at $3,500 a month. Because as the economy contracts, if it does, the people just go to less and less expensive properties. Those really expensive ones will stay empty, and ours will fill up even quicker.
And I would add on to that, we're going to be an A class, an A- class property in an A- class neighborhood, priced at, basically near the bottom of the market in that area, right? Probably a B- pricing. So I think we definitely have a competitive advantage, coming out with brand new units, and I think they're again addressing that particular segment, which is the fastest growing segment in the Kansas City market. I think positions us well to lease up. And I think we're going to start advertising these units basically very shortly and start generating a lot of interest. I mean, we're going to use we're definitely going to use, modern technology, social media marketing, Google ads and all that. But we're also going to use traditional venues. We're going to promote through the local media. We're going to generate a lot of publicity and energy around the project so that there will be a high level of awareness of what's going on and what we're doing. And there already have been a few articles written about this project, the rezoning and such. So we're definitely going to want to follow on with that and get, local media coverage as well, because obviously our demographic, we can reach a lot of our demographic through social media, but we probably can't reach all of it.
I think it's a great opportunity to talk about your past projects with John question. He says total expense and annual revenue is $8K or 42% of revenue. Is that normal for these type of projects? So I think you can talk about that, and also some of the things you did in the past, his past performance.
Sure. Was that in the chat box?
Yeah, it's the very last question that's been done.
Okay, let me go all the way down there then, just to reread that to make sure I am understanding exactly the question there. Actually, on the expense ratio, 42% is probably actually on the higher end of what we've experienced in the two previous projects that have been stabilized. The key there is obviously, we're gonna keep a lot of those expenses are fixed essentially, and we can control the labor costs pretty well in these types of apartment complexes. With the units being built out nearly new, we can keep our maintenance costs pretty low. And so, basically your insurance, once we become stabilized, will be apartment insurance versus hotel insurance. So that's going to drop quite a bit. And I think the most recent numbers I had heard were somewhere around the $25,000 fixed cost. Property taxes are again a fixed cost too. So as we get occupancy up, in that 90% plus range, the better our occupancy, obviously, the lower that expense ratio is going to be as a percent of revenue. But it is pretty normal to see. In fact, our Chaska property, I think, is running in the mid 30s, 37%. But that property is running essentially 99% occupied. So it's definitely, the key is occupancy. And we believe that, our strategy will allow us to lease up steadily through the process. And when the units are done, they will get leased. We're hoping to, generate the situation where we have a wait list the whole time, because we're only bringing on, maybe 12 to 14 units a month, which maybe sounds like a lot, but in a market that size, we could easily, get that level of lease up pre-leased.
Can I ask a follow-up?
Sure.
So as opposed to a normal renovation of a typical apartment building where expenses run 50 to 55%, if you're down at 30, 40%, then how does that flush out? Are you replacing all the mechanical systems? How are you gaining that efficiency as opposed to a standard apartment complex? Compared to a conversion?
Well, the units are smaller and more efficiently built. That's a big part of it. Obviously, we're updating windows and we're updating HVAC, and we're doing things to create as much efficiency as we can. That's certainly true. We're definitely keeping our labor costs as low as possible by doing upgrades up front, right? So that's going to minimize the amount of labor we have to have in the building, especially for maintenance, and that's going to hopefully drive maintenance costs, keep maintenance costs very low. You see new Class A buildings, some of those they'll operate 32% or something like that,
right? Exactly.
And that's what we're targeting. We basically, when we go through this, we don't look necessarily at, we think we're going to have a 42% operating expense ratio. What we do is we go through and basically simulate the operation of the building, right? We look at it as like a business, right? So we go through line by line every item. Okay, what do we anticipate for, pest control? What do we anticipate for these utilities based on, historical plus a certain percentage, right? We anticipate that utilities are going to go up a certain percentage, right? And, obviously, if you're looking at one of the metrics that you can look at is dollars per square foot of revenue, right? That's a real key thing, right? So a typical apartment complex, I think in Overland you're probably at something like $1.60 per square foot typically for revenue, okay? and there's a lot of areas, where you're probably more like $1.20 per square foot, right? Now, we obviously, everything is local, right? So we're going to focus on the local market. But, because we have, these efficient 360 square foot units, I mean, our rents are going to be in the $2 something per square foot, right? So obviously, per square of maintainable square foot, right, rentable square foot, our revenue is going to be much higher. Thus, when you look at the expense ratio is going to be lower, right? Because the cost to maintain it per square foot is going to be about the same as any other building, but the revenue we bring in is higher per square foot.
And is there a RUB system in place for these type of projects? You charge back utilities to tenants, or is that covered in the rent?
We prefer to do the one price model, and we would rather raise that one price. And I think we found the feedback that we've received on other projects is that, especially people in our 55 plus demographic, they like to, know what that expense is going to be, right? Obviously, right. If they're renting a typical apartment, okay, well, what's, our bill's going to be higher in the summer because of air conditioning, or are they going to be higher in the winter because of, heating costs or whatever, and they fluctuate, right? And they really appreciate having that one price strategy, even if that one price ends up being higher, right? If we end up raising those rates. Mm-hmm. So, I mean, I think that's our strategy will be to, obviously we want to be, competitively priced below market, but, depending upon what happens with inflation and stuff, if we come out at least up 20% below market, we're not going to stay 20% below market.
Absolutely.
Thank you.
John, I think you also asked a question about sprinkling the building.
Yeah, was the building already sprinkled?
Yeah, it is and it isn't. What I would say is about 30% of the building is sprinkled. There is a commercial kitchen in there that we're not actually planning on using. It's sprinkled, and the commercial laundry is sprinkled. The building is all concrete, and so the city's not requiring that the rest of it be sprinkled. You can't burn it down. So
right.
So the answer is yes and no.
Yes, I ran into that problem in the past. Half the building was sprinkled, and the other half of the building was not sprinkled, and it had to be brought up to code.
Yeah, so it's there. The city's fine with it the way it is. So if they're happy, we're happy. That's my
So basically, what you have there is obviously you have egress windows in every unit, right? So that's one thing. And the other thing is, the concrete walls that wrap around and through the building, and concrete ceilings are really going to eliminate the spread of fire, right? If somebody has a kitchen fire in one unit, it's not likely to take the whole complex down.
Mm-hmm. Exactly.
Well, the other thing, we're going with the induction cooktop, so it's you can't start a fire with an induction cooktop.
Mm-hmm. Great. Did you all run into any issues with replacing the walls in between the units? I mean, I've heard in the past that walls are typically thinner drywall than normal, and there's a lot of sound transmission from one room to the next. You guys have to worry about that?
The building is predominantly concrete, and so it's really very, very quiet. The only drywall there's going to be really in the rooms is there are a few adjoining rooms where there's a door. Those doors will be removing, and of course there'll be studs and sheetrock or whatever to fill that space. But we'll fill that up with insulation really well, and it shouldn't be a problem.
So the walls between the units are concrete? Is that what you're saying?
I'm sorry, John, I couldn't hear you. My phone
the walls no problem. The walls between the units you're saying are concrete?
The overwhelming majority of them are. There are.
Oh, yeah. Nice.
Yeah, there are
Even
some.
better.
There's some that are like in the suites, or like the bathroom walls. Those are all sheetrock.
Oh, looks like you guys found the perfect building to convert.
It's really nice.
Yeah.
Well, and I will say, now obviously this is a relatively newer building at 1987 build, but we look at a lot of, say, 1960s and 70s hotels, which generally don't work well for conversions, but we look at them just to see if they could possibly work. And what we find often is that the walls between the units and the exterior walls are cinder blocks. And sometimes the walls down the hallway are cinder block as well. So it isn't uncommon. I mean, it provides some definite advantages. The one disadvantage is on those older, like 1960s and 70s units, oftentimes they don't run enough electrical in there. And then it's like, okay, now we have to run electrical through cinder block walls everywhere, and that becomes very expensive. It makes the projects, you know, they lose feasibility. I mean, the other thing is a lot of those particular ones, and I think you're going to see somebody else probably doing conversions on those, but they're the typical 275 to 300 square foot, you know, units, and 90% of the units within the building are that size. You know, and obviously, our specialty is hotel conversions, and if it comes to a point where that's the product that's available, and we see that it makes sense and it leases up and everything in the market, we'll consider doing those projects. But right now, we're going to look for the best projects, right? We're going to take the best available, and so that's why, you know, we grabbed this as a best available.
And what did you guys purchase this per key? What was the acquisition price?
It was 7.66 million divided by 143.
Yeah, I think it's 40-some thousand.
Oh, that's about the average range, yeah.
David's going to give us an exact number here in just a minute.
Yeah, you can tell what I'm doing, right? I'm like
yeah.
The engineer.
53,146.
30 what?
53,146.
53,000. Okay.
And, you know, obviously it's not a perfect apples to apples comparison, but apartment units, multifamily units in that area trade for close to 200,000 a unit.
Class A.
A minus.
Yeah.
A minus, B plus, which is
right.
the prevalence of that area, right?
Right.
I mean, you get, you know, that's kind of what you get. You know, I mean, it's all based on that cap rate, right? You know, if they're trading at a 4.8 cap rate or whatever, you know, is the market cap rate in that area. You know, you do that really, really quick and dirty math where you say, okay, well, you know, the expense ratio is 45 to 50% or something like that. So then, you know, if you back out the price, right, you kind of get to, okay, well, a $1,300 a month apartment is worth about $190,000, let's say, based on a 4.8 cap rate and a 45% expense ratio.
Mm-hmm. Thank you.
So, I mean, obviously, I think one of the huge advantages of these projects is that, you know, we buy based on a hotel valuation model and we sell based on an apartment valuation model, right? So there's a significant cap rate shift that happens there in our favor, right?
Mm-hmm.
So that's why we really like these projects. I mean, I was involved in traditional multifamily before 2019, and at that point, I just started looking for something else, because back then I was thinking, well, you know, how is this sustainable back then, right? And I guess I was the greater fool then, because, you know, cap rates compressed even more after that, right? I mean, they got even a lot more expensive, right? So I missed out on opportunity there, but we just feel like we're positioned much better. You know, our risk profile, especially from, you know, potential cap rate decompression is much less, because obviously we're not, you know, looking to, I mean, I see projects all the time still where people are saying, you know, we're buying this and then, you know, we're buying it at a 3.5 cap, but hey, we're going to be conservative and we're going to exit, you know, in 5 years at a 4 cap. And that just doesn't feel conservative to me. You know, I think people will say, well, you know, cap rates are independent of interest rates, you know, and there's definitely not a one-to-one correlation between cap rates and interest rates, but you can't tell me that if interest rates, you know, if you're getting a 6% interest rate, that you're going to buy a 4 cap project, right?
Yeah,
the math just doesn't add
bond
up.
that pays, you know.
The math doesn't add up.
David, somebody asked a question about exit strategy. Did you want to speak to that?
Sure. Yeah. Basically, our mapped or planned exit strategy is a 4 to 5 year hold and then an exit at that point. But we're very, you know, cognizant of the market. We're very cognizant of you know, what a good exit would be. And obviously, if we got an offer we couldn't refuse at year 3, we would take it. We would also possibly, you know, if it makes a lot of sense, if our, you know, our valuation is strong, our NOI is strong, and the interest rate available on a refinance is low, we would certainly consider, a year 3 refinance to return the equity. If those things made sense. I mean, we're business people. I mean, I'm a serial entrepreneur. I've been, running businesses for 20 plus years, and we're definitely going to, work with our equity partners to provide the best return. So, I mean, obviously we had to have a base strategy. So that was our base strategy. Being conservative, we said, okay, we're going to get this loan. It's going to be fixed for 5 years. We're going to do the conversion. We're going to operate for a few years post conversion to maximize NOI, and then we're going to exit. Which I guess is kind of a pretty vanilla exit. I mean, that's what you typically see in projects that are coming out now. Is I mean, I think the exit strategies are being stretched a little bit in these multifamily deals now, where they're saying, hey, maybe we need to hold 5 to 7 years rather than 3 to 5, just because we're unsure of the economic environment that might exist in 3 or 4 years when we're looking to exit. But I mean, we're definitely we're not locked into the exit strategy. I don't think. Most likely our LP investors, our equity investors, maybe they would be okay with, returning 100% of equity and then holding the property long term. But generally, I think to maximize IRR, at least in the minds of the typical LP investor, equity investor, they will want to exit, probably within 4 to 5 years, even if we do a refi in year 3. And we're definitely going to work with our equity investors to, do what is the best strategy for maximizing the return. So are there any other questions that you see, Ron or Chris?
No.
Cornelius?
No, I think you got it all. So I put a link in the chat, so if you want to learn more about and see the pitch deck, and we also will send out the track record as well. We'll put a link as well. Right. Yeah. No. This is our third project as the lead sponsor. So this isn't our first run as a lead sponsor. And like I said, I've been in this space since 2019, pre-COVID, and it is our specialty now. This is what we focus on. Outstanding. Thank you all so much. Look out for the emails of the recordings. It'll be up shortly. Well, today we'll work on it. All right.
Thanks for joining us, everyone.
Yeah. Thank you. Everybody have a great day.
Thanks, Chris.
Yeah.